The Stablecoin Tethering and Bank Licensing Enforcement (STABLE) Act has significantly impacted the regulation of stablecoins in the U.S. as stablecoins like USDT, USDC, and BUSD grow in popularity. Regulators are seeking to ensure financial stability, consumer protection, and anti-money laundering (AML) compliance. The STABLE Act proposes bank-like regulatory requirements for stablecoin issuers, aiming to integrate them into the traditional financial system while reducing risks. Here are the top 10 effects of the STABLE Act on U.S. stablecoin regulation. 1. Stablecoin issuers must obtain banking licenses. Under the STABLE Act, any company issuing stablecoins must be licensed as a bank. This means stablecoin providers like Circle, Tether, and Paxos must comply with federal banking regulations, increasing oversight from agencies like the Office of the Comptroller of the Currency, OCC, and the Federal Reserve. 2. Stricter consumer protection measures. The Act strengthens consumer protections by requiring stablecoin issuers to maintain fully backed reserves in U.S. dollars or other liquid assets. This ensures users can redeem their stablecoins at face value, reducing the risk of runs on digital assets in times of financial stress. 3. Increased oversight of stablecoin reserves. Stablecoin issuers must provide regular audits and transparency reports on their reserves. This prevents concerns about fractional reserve practices or mismanagement of funds, ensuring stablecoins remain fully backed and secure for users. 4. Compliance with anti-money laundering (AML) laws. The STABLE Act extends AML and Know Your Customer (KYC) regulations to stablecoin issuers. This means companies must verify user identities and report suspicious transactions to the Financial Crimes Enforcement Network (FinCEN), making it harder for criminals to use stablecoins for illicit activities. 5. Limitations on decentralized stablecoins. One of the biggest effects of the STABLE Act is the potential restriction of decentralized stablecoins like DAI. Since these coins are not issued by a central entity, they may struggle to comply with banking regulations, leading to a shift in how decentralized finance (DeFi) projects operate in the U.S. 6. Potential increase in transaction costs. With stricter regulations, stablecoin issuers may face higher operational costs due to licensing fees, compliance requirements, and legal oversight. These costs could be passed on to consumers in the form of higher transaction fees when using stablecoins for payments or transfers. 7. Impact on crypto exchanges and payment platforms. Crypto exchanges and payment platforms that support stablecoin transactions may need to implement additional compliance measures. This could lead to delays in processing transactions, stricter withdrawal limits, and increased regulatory reporting. Exchanges may also delist certain stablecoins that failed to comply with the new rules. 8. Greater integration with the traditional banking system. By requiring stablecoin issuers to operate as regulated banks, the STABLE Act promotes the integration of stablecoins into mainstream finance. This could encourage traditional banks to adopt stablecoin technology for faster, more efficient cross-border payments and blockchain-based financial services. 9. Reduced competition for central bank digital currency (CBDC). With tighter stablecoin regulations, the U.S. government may have an easier path to launching a digital dollar (CBDC). By enforcing strict compliance requirements on private stablecoins, regulators could make the Federal Reserve's CBDC more appealing for businesses and consumers. 10. Uncertainty for stablecoin innovation in DeFi projects. While the STABLE Act aims to increase stability and security, it may also stifle innovation in the crypto space. DeFi platforms, fintech startups, and blockchain developers relying on stablecoins may face regulatory uncertainty, pushing innovation outside the U.S. to crypto-friendly jurisdictions. The STABLE Act represents a major shift in U.S. stablecoin regulation, aiming to protect consumers, prevent financial risks, and integrate digital assets into traditional banking systems. However, it also raises concerns about innovation restrictions, higher costs, and compliance burdens. As the crypto industry adapts, the future of stablecoins in the U.S. will depend on how regulators balance security with financial innovation.